Welcome to the Deep Dive. We dig through the research so you don't have to. Today, we're really getting into something huge. The relationship between blockchain and traditional banking. It's evolving fast. Our mission here is to cut through the noise, look at the real challenges, and figure out how this tech, the one behind Bitcoin, is actually reshaping global finance.
Yeah, it's a convergence you just can't ignore anymore. Traditional banking, I mean, it's the backbone, right? But it has real issues. High costs, slow cross-border stuff, security risks with all that centralized data. It's just, well, clunky sometimes. And then blockchain or DLT comes along, and it seems almost tailor-made to fix those specific things. It's about cryptographic trust versus institutional trust.
Okay, let's unpack that straight away. Banking is this, proven behemoth, centuries old, built on trust in the institution. So why is DLT, this newer tech, proving so tempting? What are its core features that, well, challenge that old model?
The challenge is baked into its design, really. Three main things. First, decentralization. So instead of one bank server holding everything, the ledger is copied across loads of computers, loads of nodes, no single point of failure. Makes sense.
Right, okay. Distributed.
Exactly. Second, immutability. Once a transaction is verified and added to a block, it's cryptographically sealed. It's permanent, tamper-proof. You can't just go back and fiddle the books. It prevents fraud after the fact. And third, there's the security itself. It uses advanced cryptography, makes the whole ledger incredibly hard to manipulate. Everyone involved can trust the record is accurate.
So the real value here isn't about completely replacing banks, maybe. It's more about offering a system that's inherently more secure, more efficient, because the trust is kind of embedded in the technology itself, not just the bank's reputation.
Precisely. That's the key insight. Banks can look at processes they've done forever and see a way to do them faster, cheaper, and crucially, with a better audit trail.
Okay, let's focus on efficiency first then. That seems like a big driver. You mentioned slow cross-border payments. That's always been a pain point, right? Takes days sometimes, costs a fortune. Where does DLT actually, cut the costs?
It cuts out the middlemen, basically. Traditional international payments hop between several correspondent banks, often using networks like SWIFT. Each hop adds time, adds fees. DLT can potentially collapse that whole chain, allow banks or even individuals to send money peer-to-peer almost instantly. That's streamlining. It has huge potential for savings.
And we're not just talking small change here, are we? The numbers are pretty significant.
Oh, definitely not small change. Studies suggest potential cost savings up to 70% in clearing and settlement. That's massive. And look at real examples. RippleNet users, some financial institutions, they've reported cost reductions around 46% for international transfers and pilots. What used to take days now takes seconds. That changes everything for managing liquidity.
That speed is incredible. But efficiency isn't only speed, right? It's also about automation, reducing manual work, human error. That brings us to smart contracts.
Yeah.
Now, most people think of legal paper contracts. How are these different? Digital, self-executing? What does that mean?
Think of a smart contract like code that runs automatically when certain conditions are met. It's like a vending machine, but for agreements. You put in the crypto equivalent of a coin, or meet a condition, the contract automatically dispenses the product, or triggers an action. If condition A happens, then action B is automatically executed by the network. No need for lawyers checking things off or escrow agents holding funds manually. The code enforces the deal.
And what's the strategic value for banks in automating things this way? Where does it make the biggest difference?
Oh, it's huge for complex transactions. Think about trade finance. Mountains of paperwork usually, verifying shipping docs, bills of lading. With a smart contract, maybe payment gets released automatically from, say, a digital letter of credit. The instant GPS data confirms the container arrived at the port. It cuts operational costs way down, reduces settlement risk because it's instant, and just simplifies things like loan payouts or insurance claims processing. Less paperwork, fewer errors.
Okay, so efficiency is a clear win. Now let's pivot to security. It sounds a bit counterintuitive, maybe. How can spreading data across a network be safer than locking it in a bank's central vault?
It flips the security model. A central bank server, that's a honeypot, a single high-value target for hackers. Breach that one point and you might get everything. With DLT, the ledger is copied maybe thousands of times. To change a record, an attacker would need to hack a majority of those computers simultaneously. The computing power and cost involved make it practically impossible for most public blockchains, and very difficult even for private ones.
And that immutability we talked about, the fact you can't tamper with past records, that must help with compliance too. Regulators must like that.
Absolutely. That transparent, unchangeable ledger is a compliance officer's dream in some ways. Things like AML, anti-money laundering, and KYC. Know your customer become easier to manage. You have a real-time, traceable record of transactions. That's why companies like Chainalysis exist, right? They build tools on top of this transparency to help banks and law enforcement monitor transactions and ensure compliance.
That covers the big institutions. But there's another angle here, isn't there? Financial inclusion. If this tech can bypass traditional infrastructure, what does that mean for the billions of people globally who don't have bank accounts?
It means potential access. Building bank branches or installing ATMs is expensive, sometimes impossible in remote or underserved areas. But, smartphones are everywhere now. Blockchain enables digital wallets, peer-to-peer payments. You don't necessarily need the bricks and mortar anymore.
So people are building systems specifically for this.
Yes, exactly. Look at something like Ulula. They use blockchain specifically for peer-to-peer banking in communities that banks might ignore. People with smartphones can essentially become mini ATMs for their neighbors, helping with cash access, facilitating small loans. It's about using the tech to bring financial services directly to people where the old system failed.
Okay, so it can help on the social front too, reaching people banks don't.
Oh.
But the real test, often, is getting the big players on board. We've definitely seen a shift. Wall Street was, let's say, very skeptical initially. Now you have giants like JP Morgan Chase investing heavily, building their own platforms. What changed? Why the shift from skepticism to, well, significant investment?
I think the realization dawned that they didn't have to embrace, Bitcoin or public blockchains directly. They could build their own private permission DLTs. Control was key. JP Morgan's work, starting with Onyx, now Kinexes, is a prime example. They developed JPM coin. It's basically a stable coin, pegged one-to-one with the US dollar, used just for settling payments between banks instantly.
And the advantage of using their own coin versus traditional methods.
It's about reducing risk, particularly liquidity risk. Settlements happen instantly, 204 zone, using this internal digital dollar. Cash isn't tied up waiting for batch processing. That frees up capital on their balance sheet. And their platform isn't just for payments, they're heavily into asset tokenization too, representing real-world assets digitally on the blockchain. They've even run pilots in India connecting 6 banks for real-time transactions. It's serious stuff.
A really major strategic move. And it's not just JP Morgan, right? Other big global banks are picking specific platforms for specific needs.
Absolutely. It's not one size fits all. You mentioned Santander. They looked at RippleNet specifically for faster retail international money transfers, and they saw that roughly 50% cost cut in their pilots. That's compelling. Then you have HSBC using R3 Corda, which is a private DLT for trade finance. Different platform, different use case, focused on managing complex documents securely among known partners, and the South African Reserve Bank.
Wow, they showed the sheer processing power, settling 70,000 transactions daily in just 2 hours using a DLT system and a pilot.
So the giants are building their own systems or adopting platforms, but there are also newer specialized fintech companies using blockchain to solve very specific banking problems. Give us a few examples there. Yeah, loads of innovation there. In payments, you see Cash App integrating the Lightning Network for Bitcoin. That's interesting because it's using a layer 2 solution on top of a decentralized network to get speed and low cost. For lending, you have firms like BlockFi was doing, or Salt currently does, offering dollar loans, but using crypto like Bitcoin or Ether as collateral. That opens up new possibilities, faster funding, maybe no prepayment penalties. Then asset accessibility. Republic is fascinating. They use tokenization to let people invest in startups or even real estate with like $10. That really challenges who gets access to these kinds of investments. And finally, data sharing. Think about credit checks. Spring Labs is building DLT networks so banks can share information signals like if someone's creditworthy without actually sharing the sensitive underlying customer data. Privacy-preserving data sharing, essentially.
Okay, it sounds like a wave of innovation, but let's bring some balance. It can't all be smooth sailing. If the tech offers so much and the big institutions are getting involved, what's stopping DLT from just completely taking over everything right now? What are the main roadblocks?
Well, the biggest technical hurdle, categorically and still somewhat, is scalability. Public blockchains, the really decentralized ones like Bitcoin or Ethereum, can struggle with the sheer volume of transactions banks need. Think millions per minute globally. When demand surges, networks get clogged, transactions slow down, and fees can skyrocket. That's just not viable for mainstream commercial banking.
So how are banks getting around that? What's the solution and what are the trade-offs?
They're mostly opting for control. They're using private or consortium blockchains, think Hyperledger Fabric or R3 Corda again. In these systems, only known permission participants can validate transactions. This makes them much faster and handles the volume issue, plus offers privacy. The trade-off, though, is you lose that fully decentralized, trustless nature. You're back to trusting the institutions running the nodes. So many are exploring hybrid models, trying to get the best of both worlds.
Okay, so technical limits.
Yeah.
But what about just integrating this new tech with systems that are sometimes decades old? That sounds incredibly complex and expensive, plus regulations.
Oh, absolutely massive headaches. Integration is a nightmare. You can't just plug blockchain into a 40-year-old mainframe easily. The costs are enormous, the complexity is high, and regulation.
Yeah.
Yeah, it's a patchwork globally. There's no single clear set of rules for DLT or crypto assets across different countries. That uncertainty really puts the brakes on banks deploying truly global DLT solutions. They need legal clarity.
Which kind of leads us to central bank digital currencies or CBDCs. If private cryptos may be too wild, maybe governments can just make their own digital cash. And the statistic is wild. Something like 85% of central banks are looking into or piloting CBDCs now.
Yeah, it's a huge area of focus. A CBDC is basically a digital form of a country's fiat currency, a direct liability of the central bank. We're seeing two main types explored. Wholesale, just for banks to settle large payments between themselves, and retail, designed for everyday use by the public, and different ideas on how to distribute them. Some exploring a direct model where the central bank holds all accounts, but more common is exploring an indirect or hybrid model, where commercial banks still manage the customer-facing side, handling KYCM.
Okay, government-backed digital money sounds efficient, maybe. But we have to talk about the pros and cons here. What are the supposed benefits and what are the risks? Because the risks sound potentially huge.
The proposed benefits are usually things like reducing the cost of managing physical cash printing, transporting, securing it. Also, potentially boosting financial inclusion by giving everyone a basic digital central bank account. And from the government perspective, a big one is traceability. It could make tracking financial crime, like tax evasion or money laundering, much easier, maybe even happen in real time.
But the flip side,
Mhm.
control, surveillance. If the central bank can potentially see every transaction, and what about bank runs?
That's the massive debate. The privacy implications are enormous. A fully centralized, government-run digital currency raises huge surveillance concerns for many. And then there's the financial stability risk, the idea of a digital run on the banks. If people panic, could they pull all their money from commercial banks instantly and hold it in perfectly safe central bank digital currency? That could destabilize the whole private banking system very quickly. It's a major concern regulators are grappling with.
So it really does look like the future isn't one winner takes all. It's probably going to be coexistence, interoperability.
That seems to be the most likely path forward, yes. A future where you have CBDCs, maybe some regulated stablecoins, existing cryptocurrencies, and traditional money all operating together. The challenge then becomes building the bridges, the tech layers to make sure they can all interact smoothly and securely.
Okay, that brings us towards wrapping up. If you had to distill it down, what's the single most important takeaway for our listeners today about blockchain's impact on banking?
I think the core takeaway is this. Blockchain isn't really replacing banks, not in the short or medium term anyway. It's providing tools, DLT, smart contracts that help banks fix their own fundamental problems. Problems of speed, cost, security, friction. It's making the existing system potentially work much, much better. It's more about evolution within banking, driven by this new tech.
Makes sense. And looking even further ahead, you hear talk about AI integrating with blockchain, automated systems running on these secure ledgers. That sounds like a whole other level of change coming.
Definitely. Smart, automated financial systems, that's likely the next frontier. Imagine AI instantly analyzing tamper-proof data for risk or fraud. And maybe one final thought to leave people with. Consider tokenization again. Breaking down huge assets like skyscrapers or bonds into tiny digital shares anyone can buy. How could that massive increase in accessibility change who gets to build wealth? Does it completely upend the idea of an accredited investor? That tension between democratized access and traditional finance, that's a really profound question to think about.